Ladies and gentlemen, good day and welcome to the Roundtable and Webinar on Revised Landscape in India for Foreign Portfolio Investments. This event is being organized by Nishith Desai Associates. The speakers are Kishore Joshi, Head of Regulatory Practice in Nishith Desai Associates, Ricky Sancheti, Head of Funds Practice Group in Nishith Desai Associates, Aditya Srinivasan, Senior Member of the Fund Formation Practices in Nishith Desai Associates. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions at the end of today's discussion. If you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone telephone. Also, you can download our mobile applet, Nishith Mobile, which is available on the App Store for iOS device, Play Store for Androids, and BlackBerry World to access the current updates and videos. Please note that this conference is being recorded. I would now like to hand over the session to Mr. Kishore Joshi. Thank you, and over to you, sir.
Yeah, thank you, and good evening to all ladies and gentlemen present here physically, and of course good morning to all the participants from the US and other parts. Let's start with yet another session on the portfolio investment regime course and ODIs. As you all know, portfolio investment plays an important role as far as Indian economy is concerned, because for almost 23 years there has been a lot of portfolio investment that has been happening. There are a lot of changes that have taken place over a period of time. Just to take you through the history of how it all started, of course you all know that in 1992 the government of India first time introduced portfolio investment regime, and in 1995 of course SEBI, being the securities regulator, notified FII regulations, and that's how SEBI started monitoring all the portfolio investment by the FIIs. When they introduced this regime, of course at that time the FIIs and sub-accounts were the two categories which they used to register with them. Over a period of time, they allowed foreign corporates and foreign individuals as additional categories for investments into India. Yet of course they had some reservations as far as foreign corporates and individuals are concerned. So even though they notified it, there are hardly any individuals that were registered. They also allowed FIIs to invest their proprietary funds through the proprietary sub-account route. The portfolio investment, of course, under the SEBI regime has been happening for almost 15 years or so. So it was in 2010 that the government felt a need that since there are these different investment regimes under which the foreign investors have been investing, for example, we have this FII regime separately, NRI as a separate category, we're investing under the NRI portfolio investment scheme. There has been these FVCIs, that's the other category which SEBI had introduced under which foreign investors were investing. So that's where government felt a need that they should try and see if they can kind of rationalize any of these categories, different routes into one, and that's where they formed a working group under the chairmanship of Dr. UK Sinha. It was in 2009. In 2010, Dr. Sinha's committee gave a report. There are primarily 2-3 recommendations, important recommendations that the committee gave. One, of course, is that there should be a separate, altogether new regime called Qualified Financial Investors Regime, which would include of FIIs, FVCIs as also NRIs, which is what of course proposed by them. And the investment under this particular regime should be less than 10%. They actually did kind of a comparative of different countries, and globally they found that a portfolio investment is made up to less than 10%, and anything above that is generally direct investments, and that's where they made a recommendation in that. Of course, neither SEBI or government kind of acted upon it immediately, and in fact in 2012 SEBI introduced a separate route primarily for foreign individuals called Qualified Foreign Investor route. That's the QFI route that came into effect. in 2013, since again there was a confusion as to whether the individuals would invest only through QFIs, NRIs would invest whether through NRI PIS or through QFI, because NRIs were also allowed to invest through QFI route. And that's where SEBI in fact set up a committee under the chairmanship of Chandrasekharan. So Chandrasekharan committee gave its report in 2013 in respect of rationalization of investment routes. They proposed a separate QFI route, again qualified portfolio investors route, wherein they indicated that all the FIIs, sub-accounts and QFIs should be brought together. They in fact recommended that NRI PIS route, which initially started by the government and the Reserve Bank of India, should not be touched upon, and that should be continued. And of course they introduced risk-based KYC and have recommended for these three categories depending on the risk profile, which report then was taken up by SEBI, and in 2014, on January 7, 2014, they introduced foreign portfolio investor regime. The important, of course, aspects of this FPI regime was that it repealed the earlier FII regulations. Of course, all the FIIs and sub-accounts were grandfathered under the FPI regime so that they could continue to make investments till their registration. The other important aspect was the relationship of the FI and the sub-account, like kind of a sponsored relationship where that each sub-account should have an FII. That has been done away with, so all the funds now could be set up independently as FPI under this new regime. The investment limit, of course, was fixed at less than 10% as recommended by the earlier committees. The three categories based on risk profile were introduced, like FPI category 1 for government related bodies. The category 2 was more for collective investment scheme vehicles or the investment managers, and category 3 that was introduced under the FPI regime importantly was for all the non-regulated or those entities which couldn't fulfill the broad-based criteria, the individuals, the family offices, they could be registered as category 3 of investors. There has been some restrictions initially even from the FII regulations on some of the structures like PCCs and SPCs. SEBI had to a certain extent liberalize these kind of opaque structures subject to fulfillment of certain conditions. So to that extent, if any of the government of any country has imposed that the fund has to be a PCC or SPC, and so far as it fulfills certain conditions, SEBI has started accepting them as the FPIs. The broad-based criteria was tweaked a little bit to that extent. What SEBI has indicated that even if you have an institutional investor into your fund, you have to have at least 20 investors. So they have done away with that less than 20 investor criteria. Of course, SEBI has still, it seems, not come out with what exactly is the institutional investor means. So they haven't come out with either a definition or a clarification. The last, of course, is the ODI eligibility criteria, which too they have tweaked, because under the FII regulations, even if an ODI which is unregulated could subscribe to the ODIs provided its investment manager was appropriately regulated. Under the FPI regulations, of course, they said that each and every ODI subscriber has to be a regulated entity. Of course, maybe we will get more into this primarily because SEBI has recently introduced a circular on the ODIs, putting certain restrictions, adding certain criteria. So let's try to understand that more in detail. So maybe may I request Richie, if you can just briefly touch upon as to what is an ODI and who can issue and subscribe these ODIs.
Thanks, Ishwar. I think just to take a cue to begin with, what is understood as an ODI in an Indian context. So an ODI is an offshore derivative instrument, which is an instrument of which can take any character. It could be a total return swap, it could be a contractual counterparty sort of arrangement, it could be a P-note, again, which is reportable to SEBI. As long as this instrument is something which is issued overseas by a foreign portfolio investor. Earlier it was FIIs, now it has been led to FPIs, foreign portfolio investors. So as long as it is an instrument issued overseas by a foreign portfolio investor against securities held by it, so it has to be on a pure 1:1 hedge basis. It can't be like, you issue ODIs, but at the hedge position you are on a unhedged basis. So if as long as there is a hedged basis of the underlying securities, and these are securities which are listed or proposed to be listed on the floor of the stock exchange or some recognized stock exchange in India, it qualifies as a reportable P-note from SEBI's perspective. Now the interesting piece here is that the securities could be pure play equity instruments, it could be units of a mutual fund. If let's say an FPI were to subscribe to units of a mutual fund, they could in turn issue on top of it ODI instruments. It could also be listed debentures like non-convertible debentures which are in vogue currently. So the underlying instrument could be any of the securities. As long as an FPI holds that and issues a tracking instrument on top of it, it should qualify as a reportable P-note. I think where the complications started arising was when SEBI for the first time introduced in the FPI regulations the concept that to be an eligible subscriber of an ODI, you have to be regulated by an appropriate regulatory authority. Now, unlike the old regulations under the FI regime where regulation 15A clearly identified who the appropriate regulatory authorities were, the reference there at that point in time was a securities regulator, a banking regulator, or a futures regulator also. Unlike that, the FPI regime under Regulation 22 does not identify which are the appropriate regulators. It is in this respect that SEBI came out with a clarification in the format of FAQs, which SEBI has been releasing, at different turns, where they said that to understand which is an appropriate securities regulator or an appropriate regulator for a ODI subscriber, they referred back to Regulation 5(1)B. And the reason why I'm doing this cross-referencing between regulations is because what had happened is 5(1)B sort of puts out which is an appropriate regulator and what qualifies as an appropriately regulated entity. So what had happened is, suddenly ODI issuers started taking a view that, okay, to be an eligible subscriber to an ODI, do you have to be an appropriately regulated by an appropriate regulatory authority, or is it only regulated by an appropriate regulatory authority? The reason the distinction becomes very critical is because SEBI in another FAQ also came out with a view that it did not perceive an investment holding company set out in Mauritius, which even though it is regulated by FSC, the securities regulated in Mauritius, it in SEBI's view is not appropriately regulated. So that is why some issuers or some intermediaries started taking a view that, okay, if is an investment holding company no longer a right entity to subscribe to ODIs. The mischief actually gets slightly elongated because when you get into the zone of where, okay, is an entity which is already regulated, no dispute about it, is it appropriately regulated or not, there are no prescribed thresholds or standards. So suddenly an entity which is, let's say, regulated by SEMA in Cayman Islands, you would take the comfort that, okay, this is regulated and its name is there in the registers, etc. But then again, the second view would need to be taken, okay, is it appropriately regulated or not? So this, we believe, is slightly a view which is more conservative than what the regulator may have opted for. Having said that, there is a basis for each view being taken. I think the entire color of this issue is yet to pan out. We are yet to see what more views SEBI or the intermediaries come out with. This clearly hampers the market. You suddenly are reducing the universe of eligible entities which can subscribe to ODIs, even though they were under the previous regime eligible to subscribe to ODIs. So I think this was one of the issues which has been vexing the market as far as subscribers to ODI contracts are concerned.
Sure, thank you, Ruchi. Let's hope that when SEBI refers in Regulation 22 to, or rather in the FAQs to refer to 5(1)B, what they meant was only the appropriate foreign regulatory authority, and that you should not jump up and see that even the regulated entity should also be then regarded as appropriately regulated, importantly for the purpose of ODI subscription. And I hope they clarify that to that effect. Aditya, you want to add anything to this? Or maybe if are there any implications of this SEBI circular?
Yeah, I think sure. So, two very brief comments over here on the entities that are eligible to subscribe to ODIs. The first, of course, is that under the erstwhile FI regulations, under the erstwhile FI regime, an ODI subscriber did not necessarily have to be regulated in its own right or regulated independently in order to subscribe to ODIs. and it was possible for a broad-based fund which is unregulated to subscribe to ODIs as long as its investment manager was a regulated entity. Now, this class of entity has been completely taken off the books as far as the FPI regulations are concerned. With, however, one little clarification that SEBI has given in question 72 of the FAQ that it released, that an existing ODI subscriber, that is as of January 7, 2014, such an ODI subscriber could continue to subscribe to ODIs even if it wasn't regulated itself, as long as its investment manager, previous investment manager and future investment managers are regulated. I think from an implications perspective, and probably Richie and Kishore, you yourself can also talk about this at length. One of the things that's happened is that I think SEBI has really clamped down on allowing entities that are not regulated by it to take exposure to the Indian public markets, and that's probably one of the reasons why it's even come out with a circular which we'll talk about at length subsequently. I think the other real implication is that, as Richie also mentioned, the universe of ODI subscribers has been reduced significantly as compared to the erstwhile FII regulations, and I think this further sort of elucidates SEBI's intention with respect to whether it wants people to participate in the form of e-votes or not.
Sure, that's true. It seems that this ODI circular seems to be SEBI sending some kind of messages that maybe you try to come directly instead of through ODIs or so. There are of course other implications which come out from this particular SEBI circular. One of course is on the clubbing of investment limits, which earlier was restricted only to the FPI direct investments and through ODIs, even if the same investors, the same beneficial owners could make investments indirectly through ODIs without any limits. So maybe Richie, if you can just explain what exactly this SEBI circular talks about.
Sure. So I think this is one clear big departure from the previous regime, where investors who could take exposures through direct participation as an FI or a sub-account, and on the other hand they could also take exposures either the same entity or within the slightly larger group level, they could take exposures through ODI route. This, of course, for several reasons could have been done to augment their positions. Maybe for certain reasons, a different group entity subscribing to ODIs, maybe the appetite for India risk was not for direct participation, but through a counterparty sort of relationship, where you don't hold rupee denominated assets, but a contractual note which may be dollar denominated on the cash flow side. So for several reasons, and this has been a development which has been sort of witnessed in more mature markets like in US, where for several reasons, including breach of takeover code or breach of reporting norms, what SEC in US had also done in 2008-9, they came out with a view that okay, if you take exposures directly through the direct investment route, and if you also take exposures through an ODI contract, the nuance in those sort of situations were that an ODI subscriber could actually instruct the ODI issuer on not only to pass on the economics of the underlying asset class, but also on how it should vote. Now this, to the minds of the regulator like SEC or more other mature jurisdictions, this in their mind sort of put together all the attributes of a beneficial owner. If you are tracking the economic ownerships and you also have the right on how the the issuer is going to vote, then in those cases they sort of club the positions both under the synthetic exposure of an ODI as well as the direct participation that you may already have through your own balance sheet. So this in their view sort of triggered the takeover norms, the insider trading regulations, the limits that an investor might have on taking an exposure to an Indian company. On similar lines, you can say that SEBI has introduced these rules that they don't want investors to sort of take exposures through the ODI route to sort of supplement their positions on the direct participation and sort of overcome or breach the 9.99% limits that they've set out for investors. However, I think it's still a phased implementation. You still don't see this sort of a collation of holdings for purposes of other securities laws like takeover code or insider trading, etc. There you still see that clubbing effect still not come into play, but it could so pan out eventually. The second issue, however, remains more from a fund manager's perspective. Now, let's say if you were to look at who the ODI subscriber is, and the ODI subscriber is giving a representation that okay, the subscriber or its investors or investor group do not directly or indirectly are in breach of these 10% position limits, then a manager would have to interact with all other portfolio managers of that particular investor group and sort of take a view that, okay, is any position that that fund is taking in breach of the 10% limit? That is one effect of it. Of course, there are a lot of representations built in this industry. The entire industry works on a basis that, okay, the ODI issuer is taking some of the representations from an ODI subscriber. The ODI subscriber could be a fund or it could be an underlying client. They in turn are giving some representations. So this entire layer of representations ultimately hinges that at some level somebody will have to collate the data on how the entire investments for a particular investor group is being panned out, and the entire thing will have to be then be added. So clearly there are solutions around it. Solutions are something which are slightly pragmatic but not exactly meeting, or there are solutions where an investor will have to give a declaration, but at any point in time the ODI issuer or the regulator can ask for some information where they may have to be in a position where they can demonstrate that they have been in compliance of this sort of a requirement. So this was more on the ODI issuer side. The other issue which has been coming out is on the clubbing, and the entire thing that, okay, the clubbing allows a grandfathering to existing ODI contracts. So to take an example, let's say an investor already holds 7 or 8% through the direct investment route of an FPI or a sub-account under the earlier regime. They also have an existing contract which allows them exposure to the same underlying strip for another 5 to 6%. So together they are, let's say, at 14 or 15%. This, in SEBI's use, is allowed to continue as long as your ODI position is still outstanding. At the date of maturity of the ODI contract or the P note, you cannot further renew it any further. It has to sort of expire on that given date. So there is this grandfathering provision where you don't have to unwind your positions in a hurried manner. You can continue holding your position, but don't aggravate the situation by taking more positions. Now this can lead to slightly more nuanced situations where, let's say, you hold direct participation to 7 or 8% or a pretty much a sizable amount, and let's say you also hold ODI positions on the same script. If, let's say, the script is not that liquid, how do you sort of liquidate your ODI positions? Ultimately, the ODI issuer is tracking the value for you, and the ODI subscriber is in a way, gaining from the value on the sale prices, etc. So if, let's say, you were to, disband your entire investments, if you were to unwind the ODI positions in a larger lot, it could impact the prices of that script, which in fact could sort of undermine the value on your direct positions. So this entire unwinding of a P note also has to be structured. Now there are different ways on how you can unwind the position. You can find a seller, you can do a bulk deal or a block deal, or you can do it on the floor of the exchange. There are different mechanisms which can be worked out depending on the commercials and specifics of each case. But like I said, this can lead to slightly more nuanced situations, and we have been advising several clients who have been sort of facing these situations.
Sure, thank you, Rishi. Aditya, if you want to add anything to this?
I think Richie makes a very interesting point when he talks about the requirement to unwind ODI positions, and the question really arises as to whether expiry of the ODI contract in itself is a fair timeline to thrust upon ODI subscribers. And perhaps what may have made a little more sense is if SEBI had allowed a slightly longer timeline and allowed for ODI subscribers to sort of phase out their positions rather than forcing them to really dispose or to unwind their position, as Richie said, at such potentially short intervals.
Sure. Thank you. Maybe turning to one more, the other issue which actually is being faced in the industry, of course, as far as portfolio investment is concerned, and that's the NRI participation per se. Of course, somehow SEBI has not been that too comfortable as far as the NRI participation through FIIs and sub-account is concerned. Most of the intermediaries must have kind of noticed this over a period of time, primarily because NRIs were traditionally having this separate route of portfolio investment to invest individually. So there have been some kind of hiccups in between wherein SEBI at times had stopped NRIs from allowing to invest through the fund entities, and then subsequently they allowed. Initially, of course, as you all know, there were restrictions on NRIs and OCBs, what is called overseas corporate bodies. That means primarily held up to 60% at least by the NRIs from registering as FIIs and sub-accounts. SEBI removed these restrictions on OCBs in 2007. and that's how at least then they started allowing the fund entities to accept participation by NRIs even to the extent of 100%. With the introduction of this FPI, of course, because of the category 3, which is more kind of a perceived as either unregulated or non-broad-based entity, it seems that SEBI has again some reservations as far as NRI participation through category 3 entities are concerned. We understand that recently SEBI had kind of a meeting with some intermediaries wherein they indicated that they would not like NRI participation into such entities from category 3 beyond 49%. So maybe to that extent, it's really to be seen how NRIs should be allowed to come under this particular route. Aditya, would you like to touch upon this recent issue?
Sure. So I don't think SEBI has been very kind to non-resident Indians at all. It was always, of course, SEBI's intention that NRIs could not apply for registration as foreign portfolio investors. That was very clear under the FPI regulations, very clear under previous intents as well. I think the only time they really ever made an exception was under the qualified foreign investors regime, where they allowed an NRI to participate as a QFI, provided that they did not already participate under the portfolio investment scheme, which the RBI had created for them. Now, as you rightly mentioned, I think where the issue really arises today is because of the fact that you have different categories of foreign portfolio investors. You have category 2 foreign portfolio investors, which includes your appropriately regulated broad-based funds, your broad-based funds, your investment advisors, etc. And this is historically the category that SEBI has been comfortable with, because they've seen them in the format of FIs and sub-accounts, and they're okay with NRI participation in that. However, when we move towards this new category, category 3, SEBI appears to not be very comfortable. Although there's something to be said about the intent of SEBI and how it's sort of evolved over this period of 7 to 8 months, really, since June 1, 2014. You initially had, and when I speak of SEBI's intent, I'm talking specifically in terms of the participation of NRIs as investors in a fund, which does not qualify for a category 2 FPI registration. So you initially had question 25 of the FPI FAQ, which specifically spoke to whether NRIs could participate in a fund. And at that time, SEBI was very clear. It said that it's perfectly all right to have NRIs as investors in a fund. It was allowed under the erstwhile FII regime. There's no reason why it shouldn't be permitted now. And let's remember that the first set of 80 FAQs came out together. And along with this question 25 was another question 37, which was a specific question as to how DDP should assess whether FPIs were funds or pooling vehicles. And there SEBI had specifically said that one of the things that they should do is to take a declaration, but the other very important thing was to look at whether the FPI applicant had a prospectus or an information memorandum or a private placement memorandum, documents that you would typically associate with a fund or a pooling vehicle. And post this, you had a subsequent set of FAQ which came out. I refer specifically to question 91, in which SEBI had indicated that a company whose majority shareholders were NRIs could not register as an FPI applicant, could not register as an FPI, category 3 FPI, or even a category 2 FPI, obviously. And it was a result of these 3 FAQ really that a lot of confusion, a lot of issues of interpretation really arose in the industry and among participants in the industry. And for some reason, the issue of whether a company which had majority NRI shareholding being eligible to register as FPIs sort of translated into the investment funds context as well. And questions arose as to whether a category 3 FPI, which had to register as a category 3 FPI, probably because it was not a broad-based entity or could not satisfy the broad-based criteria, could have a majority of its investors as NRIs. Now, as you mentioned in your introductory remarks, SEBI had apparently had a meeting with intermediaries where they clarified that a category 3 FPI could not have its aggregate participation of NRIs of anything more than 49%. And that clearly sort of, while again, we should note over here that none of this is really set out in black and white. None of this is given in writing, even in the form of a clarification. It appears as if SEBI is not comfortable with the idea of the NRI investors in a fund crossing the 49% threshold.
Sure, thank you, Aditya. So it seems that currently NRIs either can come under the NRI portfolio investment route, or they could come under a fund, a pooling vehicle registered as a broad-based FPI. Because I remember initially when this QFI route was introduced, at that point of time, NRIs also were allowed to come through this QFI route, provided of course they don't use the NRI PIS route, under which they could even set up a company in which the NRIs could put in their monies, which could be registered as QFI, which can invest into India. So while this QFI route has now been clubbed with this FPI, it seems that they have to a certain extent then now, while foreign individuals can set up a company and can be registered as category 3 and invest into India, it seems NRIs are not allowed to do that. So to that extent, at least they are put to a disadvantage vis-a-vis the foreign investors. So just moving on to other important, of course, aspects because of these changes that have been happening. The FPI regime just came a year back. It came into effect only in June last year, so it's almost 6 months. So a lot of players, the intermediaries, the investors, the ODI issuer, subscriber are still grappling with certain unanswered questions, which of course we hope that SEBI will come out wherever required. We have been having a dialogue with SEBI to try and get these answers. Moving on to the other topic of kind of a hedge funds, Richie, if you can just kind of elaborate as to, do you see any different trends into the hedge funds, the structuring or the investments?
Yeah, I think there are two observations I would like to make here, especially taking the cue from the NRI issue that you just brought out. So if, let's say, I was a hedge fund manager or a fund manager who's trying to sort of garner foreign investments into India, see, there are two tiers of fund managers. I would sort of put them in two different buckets. One is like a global general partner, like a global GP. They are raising funds at a very large scale from pension funds, endowments, providers of very extremely patient capital, which they deploy across different geographies, across different asset classes, etc. Whereas if you talk about another tier or another segment of fund manager who's only raising commitments for, let's say, India dedicated product, in those cases NRIs tend to be a very extremely critical LP base for them, because NRIs are the ones who understand the Indian asset class far better, or in a much more sophisticated manner, so to speak, than, let's say, any other investor who is only looking at India vis-a-vis other emerging markets, as opposed to, let's say, exposures to frontier markets. So NRIs tend to be providers of patient capital, so to speak, because they would understand that, okay, if there are ups and downs in the market, they can withstand it because they appreciate the asset class a bit more, as opposed to the cash flows which they may be seeing at a certain particular point in time. Now, a corollary or an effect of what we've just sort of gauged and understood is that if NRIs are to be limited to less than 49% of a sort of a investor base for a category 3 FPI, an effect of this could be slightly, ambiguous and slightly, raising headaches for a fund manager. Because if I'm raising commitments, will I every time take a stock, okay, who all investors have already committed to my fund? Have I reached my 49% bandwidth for NRIs already or not? So let's say I approach few NRIs. One NRI investor already says, okay, I confirm my commitment to the fund, and with him, I have sort of closed my bandwidth of 49%. Then would I have to then say no to the other NRI investors? That is number one. The other issue, even that global GPs could potentially face is, can they, in their subscription documents, make a statement that, okay, this is not open to investors which are of Indian origin, or this is not open to NRIs? Or if you're an NRI investor, contact the fund manager, in which case the fund manager will then take a call whether to accept their money or not. This, in my view, can potentially open a fund manager to a call of, let's say, acting in a discriminatory manner, so to speak. Like, can you on a racial basis or on the basis of somebody's ethnicity say that, okay, I take your money or I cannot accept your money, etc. Sort of justifying the entire issue over, let's say, the view of a regulator, which may not even be articulated in black and white like Aditya indicated, can be very difficult sort of a discussion for a GP when he's talking to his fund investors. That was one. Second issue, what we have been seeing is more on the asset class side, we've been seeing more and more hedge fund managers slightly looking more towards the private market side as opposed to public markets. There are illustrations replete across. You eventually saw Microsoft sort of IPOing at a early in its life stage. What had happened is post its IPO, Microsoft made good returns for its investors. That's why people sort of take a view that okay, I was an early Microsoft investor, so to speak. What has happened on the other hand is recently companies have delayed their IPO significantly. A lot of companies like Facebook IPO'd once it had gained valuations of 100 billion plus. Same is the story with Flipkart or in Uber. The examples replete. So what hedge fund managers have realized is that post the company is IPO'd in the public markets, there may not be too much of a value creation opportunity still left. So what they are doing is significantly they are participating in a private company sort of phase. So a company, because it IPOs delays, the investor at large, the public at large, which essentially participates in a company only once it has IPO'd, they are missing out on these growth opportunities. Because the company, the real value creation is actually happening these days in a VC phase or in a Series B or a Series C sort of a scenario. So we see Tiger participating directly in a round where ideally a VC would have participated earlier. One of our hedge fund clients, SteadView, they also invested $100 million in Flipkart. This is all in the private company sort of a phase as opposed to a public company play. So we see a lot of fund managers, when we are doing the structuring exercises, we create sort of a private equity side pocket where a fund manager who already has some India exposure, understand the asset class in India, they sort of raise commitments from their LP saying that okay, my core competency, my track record is on the public market side, but at the same time because of my presence in India and because I understand the asset class, allow me a side pocket where I can also take opportunistic calls on private equity side. So this is again, sort of hinges back or goes back to what is your LP composition. If your LP composition is someone which is absolutely based on returns or something who wants his redemption rights, well, let's say he says, okay, I give you cash and like any other hedge fund, unless there are gates sort of provisions on the redemptions, you give me an exit as soon as I've given you notice within 45 days or a quarterly basis or some other periodic basis. As opposed to that, if you're talking on the private equity side pocket, you're talking more patient capital investors, those who have an appetite for India risk, because the private equity side pocket would then invest in illiquid opportunities which exist in the market. So accordingly, even the LP composition is now, the demography is changing, so to speak. What was earlier a classical hedge fund sort of an investor, you may see them also having some allocations for a private equity at the same time. So I think these are very interesting times for fund managers who are operating on the hedge fund side. Private equity VC space of course continues to be very interesting. You see a lot of multiple valuation increases, turns, etc. in matter of months. So I think these are exciting times, and as as you have all been reading and following, India story has been pretty much right up there. So I think these are the two emerging trends I would sort of say.
Sure, thanks, Ajit. Aditya, maybe you want to add anything on this, especially on maybe hedge fund economics or some other trend also?
Yeah, so I'll just make a few comments on hedge fund structures and really how the FPI regulations and the way it's been interpreted, more importantly, has impacted hedge fund structures. I think one very important thing, and this borrows from the comments that Richie had made earlier, is with respect to the participation of NRIs. Now, as we understand that NRIs would tend to have a better idea of the Indian of Indian assets and would tend to have a larger appetite for Indian risk in investments and risk in Indian investments. I think one thing that the FPI regulations and SEBI has really done is prevented an NRI manager from really having skin in the game. And those generally associated with the funds industry would have a very good idea about how important it is for a manager to really demonstrate to his LPs that he has his money where his mouth is, and to really put some commitment and commit some capital itself while making investments. I think that's something that's very important. Secondly, again, as Richie had indicated, redemptions has become very important, particularly in a funds context. We spoke about how there was this issue with respect to NRI participation in Category 3 FPIs. But even if you take a Category 2 FPI which has significant NRI participation, the fund manager is always going to be looking behind his back to ensure that he does not fall short of the broad-based criteria, because should that happen, he runs the risk of being recategorized as a Category 3 FPI, and then the restriction on NRI participation sort of kicks in again. But while these are points on structuring, I think I'd like to spend just a couple of minutes to to discuss some of the recent things that we've seen in hedge fund economics. As with venture capital and private equity funds, we've seen a general shift from management fee or advisory fee towards carried interest. We've seen a similar shift in the hedge fund context from management fee towards performance fee, to achieve better alignment of interests between LPs and GPs. So today you have a number of managers who are willing to run very, very low management fee or negligible management fee, but who are willing to align their interests at the back end. That is, at the time of calculation of incentive allocation or performance fee. In addition, in order to ensure that their products are able to sell better, we've seen a lot of innovation among hedge funds as well. One of the things that we've seen is, in recent times, I think we've seen a number of hedge funds who are willing to adopt a soft hurdle prior to taking their incentive. And the other thing we've seen is that we've seen that even with the high watermark, we've seen variations where some fund managers are willing to offer the possibility of returns over the high watermark. That is the computation of their incentive or performance fee over the high watermark by adding an artificial layer of a benchmark and computing whether their performance goes over and above that benchmark. So these are some of the innovations that we've seen in terms of economics, and I think where hedge fund general partners has itself become something that's become very interesting to a lot of acquirers, and people are looking to acquire a stake in hedge fund hedge fund general partners. How they market the product, how they offer terms to the investors is also assuming a lot of importance.
Sure.
No, I think I couldn't resist, because Aditya said that, okay, if a manager were to put his own cash into the fund, it's more like skin in the game, and he put it like, putting your money where your mouth is. This reminds me of a very cruel anecdote which actually panned out. 2008-9, when Lehman Brothers sort of crashed after the global crisis, what happened, the entire tower that they have in New York was sort of, sold off to buyers. The ground floor was taken up by a restaurant. So the restaurant which was in the ground floor, which was previously Lehman Brothers building, the board outside said, "Put your mouth where your money was." So reminds of the cruel times that day.
Thank you. So it looks like very challenging and interesting time because of the changes that SEBI has been bringing into the FPI regulations. So a lot of different players, whether in India, or outside India, have to kind of put their systems in place so far as the compliances are concerned. Maybe because of these innovative trends into the hedge fund industry also, looks like the GPs would be coming out with different structures over a period of time. So to just conclude, as we have seen, SEBI has been giving kind of a challenging time, exciting time to all the different players, the intermediaries, the overseas players, as also to general partners as to how to structure different kind of hedge fund structures to try and accommodate the NRIs and other set of investors as much as possible. So in case if anyone has any clarifications that is to be sought, they are most welcome to write to any of us. We'll be happy to answer those, and if required, if there are any policy related issues, we'll definitely take it up with the regulators. And with that, I thank you everyone for taking out their time late evening, and to all other participants in the US as well. Thank you very much, and have a good night and good day to all the US participants.